Great. Okay. Well, welcome back to the Armchair Trader podcast. And on the podcast today, we have Nitesh Shah, head of Commodities Research at WisdomTree, who is joining us to discuss all things commodities markets. He has been on the podcast before, but we thought it would be a good idea to get him back on just to catch up on what's been going on in the commodity space over the summer. We're going to be looking at a number of different markets, including the usual favorites with traders. And I thought we would kick off talking about the energy markets. But firstly, welcome to the podcast, Nitesh.
Thank you for having me back on again.
I thought we'd start with the popular one. I mean, this is the oil market, and certainly from my experience working in the CFD space, that was the contract that used to get all the volume from traders. It's certainly the favorite one. Oil. I mean, my impression of covering oil over the last 6 months has been that it's. My impression is that it's turning into a little bit of a tug of war between, on the one side, you've got China, which is a major consumer of crude oil, where the economy there is, as far as I can see, definitely in trouble, and that's creating a bear case for oil. But if you set yourself up on a sort of China oil bear trade, you're always going to be caught out by the Saudis, by OPEC, by Russia, who will just say, "Hey, we're going to cut oil production." Sometimes out of schedule, out of an OPEC meeting, and then all of a sudden the price rallies. So we're seeing a little bit more what I would call strategic volatility in oil markets at the moment. But what's your impression of it?
Yeah, I think you've got some great observations there. And when it comes to oil, it's a strange commodity because a good 45% of production is controlled by OPEC and its partner countries. So they have a very meaningful impact on prices and on supply demand balances. And it's been very clear that um, Saudi Arabia in particular wants oil prices around the $90 region. And why is that? Well, mainly because that's roughly where its fiscal break evens are. And what I mean by fiscal break evens is what is the price of oil that its government needs to be able to meet its government expenditures, mainly social expenditures, with its revenues, tax and mainly oil driven revenues that come feed through from Saudi Aramco. Saudi Aramco on its own, if you're just looking at it as an independent company, yeah, it could break even with oil prices as below $50. But the government needs something closer to 90, and that's why it's been so keen to keep prices that much higher. Other OPEC countries have maybe even higher fiscal break-evens, but it's unrealistic that they'll ever get there because that will push oil prices to a place where it's inflicting global pain and it will set on global recession, and that will damage the demand. So OPEC has got that vested interest for around that $90, and with Saudi Arabia being the largest producer, the one with the most spare capacity and therefore the most muscle to flex within that organization, is keeping it at that level. But you're right that the demand side of the equation is a little questionable. If you look at 2023, 70% of the growth in oil demand has come from China. That's a huge number for a country that is going through economic pain. Now, a lot of its oil consumption is driven by the fact it's taking in crude, processing it, and sending it to other parts of the world. Um, so, rest of the world's strength matters, but if China weakens a lot more, then that demand part of the equation becomes a little bit more questionable. And I think that's what OPEC keep picking on when they keep in justifying why they're keeping the markets tight and restricting supply. They're always pointing towards the weakness in potential weakness in demand coming from China. China has been stimulating its economy recently, and if you look through the last couple of months, almost every couple of days, it's making some sort of stimulus announcement. They're all small and very piecemeal. It hasn't come up with any big bazooka like it normally does in the most weakening cycles historically over the last 30 odd years. Um, this time around is different. They're doing lots of small targeted things. In accumulation, they're all accumulated together. It's meaningful, but nothing really ever grabs a headline because they're all very small individually. But we are starting to see that strategy bear fruit. If you look to the data points from the last couple of weeks, we've seen purchasing managers indices from China um, rise above 50 for 2 months consecutively, actually. So that's 50 is the demarcation between contraction and expansion. We've seen industrial production data rise and beat consensus expectations. Total social financing, so aggregate financing to the real economy, has picked up after a couple of bad months. It's picked up quite substantially, and retail sales are up as well. So all the indications from a macro standpoint is that it's working, but we don't have that big bazooka. And the worry is that these small piecemeal stuff could fizzle out over time as well. So a little bit of risk on the demand side, but I feel on the supply side, Saudi's always ready there, and Russia is a willing partner. It's ready to cut back on supply to keep it at that sweet spot of 90. One of the areas where we saw supply expansion while OPEC was contracting was from the US, and US is the biggest oil producer in the world. And it was expanding oil while its rig counts were declining. But over the last couple of months, it's actually seen its supply decline as well, in line with its rig count. So that little magical trick it was performing, somehow expanding production with less rigs, has come to an end as well.
I mean, it's interesting because looking at the oil chart, oil's been in a relatively bullish phase since July, and certainly Saudi was successful in pushing it up past $90 a barrel in September, and then it's been trading, around about the 95 mark. But then just recently, it's really seems to have fallen off a cliff, and we're now, at the time of recording, we're at around $84 for Brent crude. What's causing that? Is it just bad data from China, and do we therefore expect that if this continues, if it drops below $80, then Saudi's going to like tighten the taps again?
Yeah, I think what's happened over the last week is we've had that massive bond sell-off. Bond yields have risen substantially, and there's lots of fears about what that means for the global economy. Are we seeing, the makings of the next recession really come into play? And I think there's a lot of fear right now that demand could be a lot weaker. Um, and I think we're heading into a period of really uncertainty. I mean, what we're seeing is essentially a bear steepener in the bond yield curve, right? So, the curve is becoming less inverted, but not because short rates are going up, which was what you normally find in steepness, is because um, it's because of movements sorry, short rates normally go down, causing that steepening, but right now we're seeing the longer end going up, and that's rarely happened before, and that's creating huge amounts of uncertainty. I think that right now people are worried about the demand part of the picture. This higher for longer narrative is keeping people a little bit worried about whether central banks will or of developed economies will push their economies respectively over the edge. There's relatively few experiences of soft landings, even though we all seem to be, liking the idea of that concept. There are relatively few examples of that, and so I think people are just a bit more worried about acceleration into recession, and that's caused that quite substantial $10 decline in oil prices in the span of about a week.
Moving on to the gold price, because then again, gold is the other one a lot of traders follow. That's not been having a good time either. That's been dropping. I know we discussed this on our last podcast, and you get a lot of gold bulls in the market who keep talking about how it's going to go to $2,000 and $3,000, and this never seems to happen these days. What are you seeing in the gold market?
Yeah, so gold. It wasn't doing so bad just a couple of weeks ago. In fact, when we saw the extreme bond headwinds and dollar appreciating quite substantially, gold was holding steady. And but just in the last week or so, it's capitulated. It's succumbed to those pressures of higher bond yields and an appreciating dollar. Um, Now, when it comes to gold, a couple of observations we've had is that institutional markets have been largely shunning the metal. I mean, we haven't seen huge flows into, we've seen outflows from exchange traded commodities, and not any meaningful inflows. If you look at speculative positioning in futures markets, they're also moderating quite a bit. But if you look at some of the retail markets across the world, they're looking extremely strong. If you look to Turkey, for example, a country that's had, both political and economic disruptions over the course of the last year, they had to even ban gold imports for a while because the demand was so strong. The central bank of Turkey was had to provide that liquidity into the market, was selling gold to meet local demand. But it's not just Turkey where you see that uh, political economic issues. China, we're seeing gold demand there extremely strong, and in fact, if you look at the so-called Shanghai premium, the premium of gold largely supplied to its retail markets in China over and above the London Bullion Markets Association (LBMA) prices of here, that has actually hit record highs. So there's huge strengths in some parts of the world, um, but I guess in our part of the world it's just looking a bit weaker. And obviously, if you look at gold in dollar terms, it's looking quite weak. When you convert it into yen terms, it's actually close to all-time highs, and even in euro terms, it's not doing so badly because once you take that currency effect out, but the bond headwinds right now are looking like something quite meaningful. The question is, will that turn around? And if you look at consensus, where most economists are expecting um, bond yields to go over the next year, they're supposed to ease off. We'll hit close to 5% on the 10-year earlier this week, but by middle of next year, we're thinking the consensus is talking about closer to 3%. So that will be meaningfully positive for gold prices. Consensus is also expecting a depreciation in the dollar as well, so that should be good for gold. If all these things happen, my models are indicating by Q3 2024 we should have gold prices of around 2,130-ish. That will be an all-time new high in nominal terms, not in real terms, but in nominal terms. Um, so that's good. Um, what do we think? I mean, I think we believe in this higher for longer narrative that central banks will keep rates higher. That'll probably you know keep bond yields relatively high, but we do think they're going to ease from these levels. Right now, we're probably at peak pain threshold for the bond market, and that needs to ease off over the coming months.
So really, what I mean, the story here is that the bond market is very much in the driving seat when it comes to precious metals, because we're seeing silver also selling off at the moment. And is that presumably the same impact as we're seeing in the gold market?
Yeah, it's very much the same. I mean, the gold silver correlation is generally very strong. 80% correlation between the two. When you're seeing a big moves in gold markets, you tend to see that big move mirrored out into silver. Um, Silver often acts with a bit of a lag, so you see gold move first and then silver follow. Um, but what we do expect is that as the as time progresses, we are quite late into the economic cycle, and commodities in general are uh, they're late cycle performers. So we've seen that already. Apart from the little pullback in oil over the last couple of weeks, we saw oil prices rally. We expect metal industrial type of metal prices will also rally as well, and therefore silver, which has a bit more industrial traits, has the potential to possibly outperform gold, assuming that we can maintain relatively healthy economic outcomes. Obviously, what's going on in the bond market right now is creating a lot of questions around that.
Moving on to another commodity that maybe is less influenced by the bond market, and that's the natural gas market. I mean, if you look at that one, I mean, certainly if you've been following it over the last sort of 2 or 3 years, we saw that massive rally in natural gas prices when the Russians invaded Ukraine. That created a lot of volatility, some very high natural gas prices. Then over the last winter, it has surprisingly, as we moved into the spring of this year, the prices really dropped. And certainly my part of my impression of that was a lot of governments have been filling their natural gas storage facilities to the absolute brink in anticipation of the next winter because they don't want to be caught on the hop like they were in February 2022. Do you think is that what's happening? Is it just the fact that everyone's just been buying like mad and now everyone's got enough gas? Appreciate that the market in natural gas has been relatively range bound over the summer months, but we are now moving into the winter. So, do you think we can expect some more action in that space?
Yeah, great question, and it's worth just putting a bit context here that natural gas markets across the world are really fragmented. It's not like the oil markets where we can talk about you know one couple of benchmark prices like WTI and Brent, largely you know representing the world got oil prices. When it comes to natural gas, huge price differences across different regions. You've got the Henry Hub contract in the US, which is the most liquid and most traded contract, the most accessible for investors. So that's where we tend to focus on in terms of prices. But here in Europe, there's the title transfer contract, which is at least 5 times the price of the Henry Hub contract. And obviously, Europe has been at the epicenter of this energy crisis that started off with the Ukraine war last year. Now, the Ukraine war last year sent gas prices in Europe up 50-fold. It was hugely influential on that, and it had a knock-on impact on the U.S. Prices because U.S. gas can be exported through liquefied natural gas to other markets. It's not that easy as going through pipelines, and that's why you have these big price differentials. But it can be so that's why we saw that big knock-on impact onto Henry Hub last year. But when we came to the winter of last year, um, it turned out we were extremely lucky. Europe had a very mild winter and didn't need anywhere near as much natural gas as was expected, and prices came crashing. And then they crashed further into this year because uh, the European Union has been building out a lot more storage facilities and filling those storage facilities to really high levels. Their target was get them 90% full, and they kind of met that target a couple of months early. So we're sitting here right now on the brink of winter with lots of natural gas in all the storage facilities around Europe. Um, and so we're in a relatively good place. That's why natural gas prices are lower right now than they were even before the Ukraine war started. But we're not without risk. The flow of natural gas from Russia into EU has trickled down to zero. So you have to rely on all this on this inventory. If you have a cold weather spike, that would run down the inventory very, very quickly. Now, weather forecasting is one very difficult thing to do. Beyond a couple of weeks, it's very hard to make those forecasts. So, there is that risk of a cold weather snap. Maybe less likely because we are in what was called an El Nino weather pattern, and we are seeing some warming as a result of that. So the winter is more likely to be warmer than it is to be colder than normal. But once again, weather's a hard thing to predict. Um, Also, we may see a little bit of softening of demand if the economy is if the effects of all this monetary policy is taking effect and we start to see the economy slow down. So we're probably going to see enough natural gas supply and be in a sort of plentiful um, supply to meet demand. But once again, weather could change the cards pretty quickly.
Yeah, I mean, I'm just looking at the pricing of the Henry Hub from so basically over most of 2022. In fact, when it hit $10, um, investors looking for that. I mean, and this is just me, but it sounds to me like they're probably going to be disappointed this winter. They're not going to see anything like those kind of highs, even if we have really cold weather.
Prices could rise, and cold weather snaps generally are the catalyst for those spikes. But it becomes quite a tactical move, right? It becomes like, okay, a weather event is happening, then the price will go higher. Whether that price will remain sustainably higher is another question. Um, and I think with the US also on the supply side, supply is quite strong for natural gas. A lot of the shale oil fields are actually getting a lot more gassy. So when you're trying to pull out oil from the ground, you're getting a lot more gas coming out of that, which is coming into the supply stream. Um, Also, while there is all this demand for liquefied natural gas from Europe and Asia, um, and the US is obviously a big supplier of that and is expanding its LNG export capabilities, it's not expanding fast enough. And therefore, a lot of the natural gas is being trapped in the US and therefore weighing down on the Henry Hub price as well. So a couple of bearish aspects there. But once again, cold weather snaps that could drive prices higher, but very much a tactical move there.
And I just wanted to talk a little bit about the agricultural commodities markets, and a couple of ones that we've been following here at Armchair Trader. One was the wheat futures prices. There was obviously again Ukraine war, and the fact that Ukraine's a big wheat producer did drive prices up. But if you're looking at the course of wheat prices more recently, there seems to be a steady downward trend. Certainly, Chicago wheat futures have been gradually slumping since the end of July. What's your observation there? What's causing that?
Yeah, so obviously, putting back in context, last year was the year when the war took place, and Russia, Ukraine, the bread bowl of Europe, bread basket of Europe. They produce huge amounts of wheat, corn, all the oilseeds. Prices rose substantially there. Um, but now this year we are seeing actually supply surprises on the upside. Um, US has had a good crop yield, but also so is Russia, and Russia is being able to export that into the global markets, even though Ukraine may be struggling because its grain deal with Russia has come to an end. So getting the passage of grains out of Ukraine is difficult. It's not so difficult for Russia, and Russia's flooding the market with its bumper crop, and US is also produced a lot, and that is weighing on US prices, and obviously the Chicago contract is probably US production is probably more influential on the Chicago contract than production even elsewhere. Same sort of problems with corn. A lot more production than was anticipated. I think earlier this year, people were really worried about lower yields, but those worries are somewhat misplaced, and we are seeing those yields actually, reverse and actually look pretty strong. Once again, um, we're not really, you know, the El Nino weather phenomenon that I mentioned earlier on is very influential on the agricultural space. Um, and, even though we may be seeing a nice harvest, not a nice sort of crop that's in the ground, that's being produced, there is the risk that during the harvest period, um, the weather could turn. And so a good crop on the ground may not be able to be picked in a timely manner to full effectiveness because of possibly excess rain, for example, and that may be brought about by the El Nino weather phenomenon. So it's not a done deal that that the good yields of the crops will permanently bring down the price for this season. There is still weather risk out there that a good crop in the ground may not get harvested.
And speaking of El Nino and weather risk, I mean, has that had a contributory factor in the cocoa price? Because cocoa, if you're looking for some upside in the agri commodity space, cocoa has had a very good run of it actually this year, with the price really only peaking beginning of September and starting to come off a bit since then. But certainly when we were looking at the price, you could have ridden that story all the way from April and made some decent money on it. What's been the driver there?
Yeah, so there is a lot of supply concentration for cocoa. West Africa represents close to 70% of all cocoa production. And there's been supply concerns from there. So if you look at the Ivory Coast, its exports last month declined about 10%. You've seen a big spread of this swollen shoot virus from the country, and weather hasn't been particularly cooperative, and obviously a lot of that is due to this El Nino weather phenomenon. The virus has been able to excel with this adverse weather conditions in the Ivory Coast and in West Africa in general. So um, you know, I think cocoa supply has been affected by El Nino, but it's not just cocoa. We see sugar. Sugar prices rose more than 10% last month on the back of these extreme weather conditions, and also coffee as well has seen some gains. Now, El Nino tends to impact the tropical regions a bit more, and obviously these softs, cocoa, sugar, and coffee, tend to be more concentrated in so-called tropical regions, more so than grains, and that probably explains the little dichotomy between why grain prices have been falling while the softs have been rising over this period. Sugar is obviously of key interest, and once again, you've got supply concentrations in the cane as well, with Brazil being a large producer, but also um, India being an extremely large producer. India is considering putting an export ban on its sugar exports because of a relatively low crop this year. And India goes sometimes from being, even though India is one of the biggest producers of sugar, it's a large consumer itself, and so it goes from some years of being a net exporter to some years of being a net importer. And if it puts export ban in place, it's more likely to tip on being a net importer this year to fill its own sugar needs. So yeah, quite a few areas of strength there. Once again, driven by this weather phenomenon.
And I'm aware we're running out of time, but I wanted to just also touch on industrial metals because this is an area where you have also ETFs tracking industrial metal prices. What's the situation there? I know that obviously there's big worries about potential slowdown in the global economy. Again, maybe slackening of demand from China. How are you seeing that over the winter?
Yeah, I think you hit the nail on the head there. China is probably the key concern because it is the largest metal consumer. So that weakness that we've seen so far hasn't been encouraging, but the stimulus that we seems to now seem to be taking effect on the economy is a reason to be somewhat more optimistic. But also, China is using this period opportunistically as well. With the relatively weak copper prices that we've seen, it has been excelling its uh, grid expenditure. So on electrifying its grid, or improving its grid to be able to take on more electrification, especially of vehicles, is spending a lot more money on copper. I think that's something that's going under the radar at the moment, because if you look at where copper prices are trading, it's just based on traditional macro indicators. And if you take traditional macro indicators, you would think that China's demand for copper should be going down heavily. It isn't. It's quite flat, and in fact, it's somewhat increasing because of its diversion towards grid expenditure. Um, so we may end this year. The International Copper Study Group, which met this week, has maintained a deficit forecast for this year. Supply of refined copper will be less than the demand for it, and we're still continuing to eat above ground inventory, and inventory is falling quite substantially relative to 5-year average. Um, Copper, we see some strength, but where we see strength in the metal market is a bit more of a longer term story. It's because metals are so instrumental in the energy transition that we're likely to see. I talked about China electrifying. All other countries need to make that electrification leap as well if they are to meet their net zero targets. And the the vehicles that are used, electric vehicles, which will surpass uh, internal combustion engine vehicle sales in due course. They're significantly more metal intense in the creation of the vehicles as well. So we're very optimistic on nickel, lithium, cobalt, and as you point out, our products cover some of these as well. We have an energy transition basket with lithium and cobalt in them, which is very unique. And while right now the short-term oversupply in lithium and cobalt, we expect that to turn around to a massive deficit, within coming years. And obviously, if you're looking for long-term plays, they look very interesting.
Brilliant. Well, thank you very much indeed for your time today, Nitesh. That's been really informative. Certainly a lot for investors to look at in the commodities markets over the next 3 months or so. Thanks for all these insights. It's been really valuable.
You're most welcome. Thanks for having me on your show.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news, and sign up to our free newsletter there.